Larry, I wanted to get thoughts on PPI, but maybe even more importantly, one could argue CPI data this week. Not only here in the U.S., though, we saw it earlier in the week in terms of Asia, muted across the globe.
Yeah, it definitely was. And the PPI today was just a mid-morning distraction. It's mid-morning for me, I guess. But given what CPI did yesterday, and it was really, it was exciting to see. But on the other hand, just have to be manage the expectations of CPI and just realize that it went up from a very low level, very depressed level. And I think the nuance going forward is something that a lot of us aren't thinking of, and that is the trade war. And and that was the big tradable theme before the pandemic. And so PPI to some degree is influenced by that, and going forward into 2021, something to watch.
All right, so expectations. I saw the ECB yesterday basically pointing out that they don't expect inflation to be runaway concerns or sparking runaway concerns at any point in the near future. Is this the trend? Should we continue to get used to it? There was a lot of talk recently about how the Fed would be willing to see it up and through 2% level, but I was kind of surprised to see how much attention that talk was receiving, considering that we still were nowhere near. So, I mean, it just didn't really seem to be that relevant at that point. I mean, but one could argue once inflation starts to come around, it could rear its ugly head quite rapidly. We were just talking about commodities, for example, copper. We've got beans. We've got multiple markets you could point to that are potentially showing signs of.
Yeah, exactly. And iron ore, another example, 8-year high this week. I mean, who would have guessed? But inflation, like you and I both have been in the markets long enough to realize that inflation can poke its or rear its head at any time and just catch everybody off guard. But that said, I still am trading with what in mind, that the structural changes, the demographic changes, the excess capacity in our global economy is going to keep inflation at bay. It's really nice to see, fits and starts with regards to inflation, but I think overall it's going to be lower for a lot longer, and it's due to just more changes in our society more than anything else.
All right, let's talk a little bit about some of the central bank activity we saw this week, because it's a bit of a precursor for next week. The Bank of Canada, the ECB, as I just mentioned, we heard from them, but leaving rates unchanged for the most part, in line with expectations. Some slight tweaks from the ECB yesterday, but anything stand out this week? Anything from Lagarde yesterday? And what are you looking for ahead into next week? The FOMC, Bank of England, and Bank of Japan we'll hear from.
Yeah, there's a lot. And so another big thing that happened this week that a lot of people missed was RBA, Royal Bank of Australia, actually for the first time introduced short-term bonds with a negative rate. That's never happened before. And all that to say, Australian dollar hits a 2.5-year high and continues to climb. That said, I think really more the presser yesterday with the ECB was fascinating. I think it really did help a little bit with our bond market, because ECB, to a large extent, is following our lead with regards to allowing inflation to overshoot, or at least wanting that intention. All that to say, with their presser, it just seemed to me that it's going to be a lot harder for the Fed to raise rates anytime soon, or at least anytime before 2021. Next week, we have, as you mentioned, the FOMC on the 16th. And I think the big wild card is weighted average maturities. Will the Fed extend that? I'm in the camp that thinks that they won't, but they will next year, early next year. But if they do, it's going to change the dynamic of the 2-10 spread, the difference, interest rate differential between the 2 and the 10, something to really keep a close eye on.
Yeah, I want to get your thoughts on that in just a minute, but first, where does this all leave the dollar at this point? It's been weakened significantly, holding, not rejecting these lower levels. 90.47 was the low we recently saw, but there's some major support down around the 88 area I saw recently, but certainly it seems to be kind of limping on into the end of the year.
Yeah, that's a great way to put it. And I just don't think the dollar really has anything to gain presently. And the reason being is that the market overall is upbeat about the future. And on the other hand, the Fed is very worried about the present. So there's no incentive, as it were, for the Fed to do anything drive the dollar up. I mean, there's definitely some twist to that. I mean, right now the Fed is staying very, very cool. The market's pricing that in. And also, there's been a huge pandemic fiscal policy convergence around the world. You know, you've had central banks that haven't wanted to go easy, but they've had to. You've seen interest rate differentials go down. You've seen yields around the globe go down. So all that to say, it's all negative for the dollar. I am a long-term dollar bull. I know that that's an outlier, but that said, like presently, it's limping, and I think it's limping along because it has nothing to gain presently by going higher.
Yeah, no, definitely hasn't, as I mentioned at the top of the show, it has not opened up the door to the downside or stepped into that elevator shaft yet, that's for sure, but it has been trending lower off the 104 handle. All right, you briefly touched on rates. I wanted to dive a little bit deeper in to that discussion as well, if we could. You were talking about the spread, the yield curve. I wanted to talk about the TNX, the concern related to the 1% level, but then ultimately the tie that it has into the Fed's influence on the shorter data, as you were talking about, versus the longer. Can you touch on that a little bit?
Yeah, so right now people are thinking that we're going to see a steepening, and so what that means, you have the difference between a 2-year and a 10-year widen. It has widened quite significantly, but now it's in the high 70s. But I think a lot of people are thinking it's going to go much higher, and it's really predicated on the Fed expanding or not expanding weighted average maturities, and if they do, then that's going to change the dynamic, and that's going to see 10-year yields go lower. So that would like narrow the spread. If they don't, then it'll widen the spread. So I think that's the gamble right now with the differential between 2-year and the 10-year. And today's action is just really more of a reactive from what happened yesterday with the market being just slightly oversold. You have people just buying treasuries into the weekend just for risk management purposes.
All right, Larry, headed into the end of the week, into the end of December, into the holidays, we have coronavirus vaccine news, stimulus measures. We've got some focus on central bank activity. There's a lot on investors' plates. Talk to us about what's at the top of your list and what we should be watching, whether it's economic data or some of the inflationary pressures we were just talking about. What stands out here right now into the end of the year?
Yeah, I think the end of the year, it's all about the pandemic, the trajectory. Economic data definitely taking a backseat because it's back-looking, not forwards-looking. So I think it's really the pandemic. I mean, immediate term, definitely the Fed next week. But beyond that, end of the year, it's really the perceived pathway, the pandemic. And what that does to jobs will continue to go lower. And then after that, the economic data will start to matter. But right now, it's all about the pathway.